Hi, this is Lisa Busto from Harper College. We're going to take this opportunity to review Chapter 11, which is about reporting and analyzing stockholders' equity. So, first of all, we want to talk about the major characteristics of a corporation because that's what our accounting focused on throughout the text. And an entity is separate and distinct from its owners. It could be classified by purpose or classified by ownership. And it gives you some examples. One of the things, there are certain advantages and disadvantages of a corporation. And you should make sure that you review and understand these characteristics. One of the things is that a corporation, here are some of the advantages. A separate legal existence, so it's separate from its owners. So you can't go over the investors. If I'm a stockholder, you cannot go over after their assets. So if I own stock in a company, you can't come after my house. The most that a investor can lose is their investment. So if they invested $500,000 in a corporation, and the corporation loses money and files for bankruptcy, the most amount that I could lose would be my $500,000 investment. And this is true whether it's a publicly held corporation or a privately held corporation. So the most you can lose is up to your total investment. There is limited liability of stockholders, as I just mentioned, separate legal existence, so it's not tied to a person, it's its own separate legal entity. It's easy to transfer ownership rights, ability to acquire capital, and there's continuous life. If shareholders die, it's easy to transfer ownership rights, and it doesn't stop at any point the corporation. Also, some advantages is, or they kind of tie this, it could be an advantage or disadvantage, corporation management. One of the definite disadvantages is that there are a lot of government regulations and additional taxes surrounding corporations. So that's a little bit about the characteristics about a corporation. So make sure that you review the advantages and the disadvantages of a corporation. There are many steps to forming a corporation. You file an application with the Secretary of State. In Illinois, it's a pretty easy process to file an application. The state grants the charter, and the corporation develops bylaws. So it's pretty easy to form a corporation. So, but when we form a corporation, one of the things is that we have stock to issue. That's one of our considerations. And there's authorized, issued, and outstanding stock. And you must know the differences between those three. Authorized is when you set up your charter, your company charter with the state, a corporation will put in an amount of stock, the maximum amount that is authorized. Usually it's a really high amount, so that they don't have to go back and amend the charter with that authorized amount. We also talked about issued stock. Issued stock is either treasury stock or stock that's in the hands of investors. And then outstanding stock is any stock that's held outside the company. So usually when I draw this diagram on the board, the largest circle is the authorized. Then issued is another pool of that stock, because they're not all the authorized stock isn't issued. And then a smaller circle inside of that would be the outstanding stock. A corporation can issue common stock directly to investors or indirectly through an investment banking firm like an Edward Jones or a Fidelity. And then the top 5 exchanges by which shares are traded are the New York Stock Exchange, the NASDAQ, the London Stock Exchange, Tokyo, and Euronext. So with stocks and the stockholders' equity, one of the things is we have a lot of terminology. And so we want to become familiar with this terminology. So let's start with par value. So par value is a capital stock that has been assigned a value per share. One of the things is this is pretty much an arbitrary value. It is usually a low dollar amount. Sometimes it's a penny, sometimes it's $1, sometimes it's $5. The reason that this started is years ago, before the Great Depression, par value determined the legal capital per share that a common company must retain in the business for protection of corporate stockholders. So at that time, I should say right after the Great Depression, they felt that there was a need to protect investors. Many states do not even require a par value when you set up your company charter. No par value stock is fairly common. It's not required. In many states, they board of directors assign a stated value to a no par shares, and the stated value is really the same thing as par value. Oops. Sorry about that. So, and I want to correct myself. Years ago, and I'm talking about after the time of the stock market crash in the Depression, when they felt that we needed to protect investors, we developed this par value concept. So, corporate capital. It's very important that you understand that there are 2 primary sources of equity. There's the paid-in capital, which includes common stock and preferred stock. Those are the 2 classes of stock that we'll talk about. And the other is retained earnings. Now remember that paid-in capital is the total amount of cash and other assets paid into the corporation by stockholders in exchange for their shares of ownership. So in class I've used the example of if my brother and I wanted to start a pizza place, and my brother put in $10,000 and I put in $10,000, that would be our paid-in capital to start the business. Then my brother would have 5,000 shares and I would have 5,000 shares. That's an arbitrary number that I'm just pulling out there depending on what we set the par value amount for our stock. So, and how many shares were issued with that. So paid-in capital is one part of the stockholders' equity section, and the other is the retained earnings. Remember, we talked about retained earnings throughout the course is the net income that the corporation retains for future use in the business. So we're retaining it or we're holding on to it. So let's look at common stock. In this review, I want to make sure that you understand common stock journal entries. So this is an example, very straightforward, and you have to make sure that when you're issuing common stock, what the proper journal entry is. So this says, assume that Hydroslide issues 2,000 shares of $1 par value common stock. Prepare Hydroslide's journal entry if 1,000 shares are issued for $1 per share, and B, 1,000 shares are issued for $5. So in the first journal entry, and we should first dissect the information and take out what we need. 2,000 shares at $1 per share. So the first transaction is 1,000 shares issued at $1 per share. So in that case, the purchase price and the par value, there is no difference. So there is no additional paid-in capital in excess of par value that transaction. So we would debit cash for 1,000, credit common stock for 1,000. In the second transaction, it said 1,000 shares are issued for $5 a share. So we received, Hydroslide received $5,000 cash, and common stock is always recorded at the par value if we have a par value, and then the difference between the $5 per share and the $1 par value would be $4. $4 times 1,000 shares would give us this paid-in capital in excess of par value. So make sure that you can do the journal entries for the basic common stock issuance for cash. Here's how it would look on HydroSlide's balance sheet. Remember, we talked about the importance of understanding our two sections of equity, paid-in capital and retained earnings. We have listed for this right now, we only have one class of stock, common stock, and then our paid-in capital in excess of par value. Our total paid in, our investors put in a total of $6,000 in exchange for stock. So let's look at preferred stock. Preferred stock typically have priority. One of the main things is that they receive priority with respect to dividends. Also assets, if there's a liquidation of the company, it goes bankrupt. But one of the things with preferred stock is generally they do not have voting rights. So that's one thing to remember about preferred stock. When you're looking at some of the questions at the homework or the exam questions, make sure that you look at it carefully and understand, is this common stock? Is this preferred stock? Okay. And we also want to distinguish this paid-in capital. So our paid-in capital in excess of par value, we would have preferred stock, and paid-in capital in excess of par value common stock. So we can distinguish what is the paid-in capital for each class of stock. Here's an example. Stein Corporation issues 10,000 shares of $10 par value preferred stock for $12 cash per share. Journalize the issuance of preferred stock. So the par value was $10 times the 10,000 shares, but they paid $12 per share. So we take $12 times 10,000, and the cash we would receive would be $120,000. Our common stock before always received that par value. Now the same thing for preferred stock. We take the $10 par value times the 10,000 shares, gives me $100,000. The difference between what the investors paid, $12 and $10, is $2. So $2 times 10,000 would be that paid-in capital in excess of par. Preferred stock can have a par value or a no par value. Remember, not all states require you to have a par value, so that's fine. One of the things I want to mention is treasury stock. Treasury stock is always a subtraction in our stockholders' equity section. It goes after retained earnings. Treasury stock is the stock that we bought back. We reacquired it and we're holding it for future use. So treasury stock is simply when we're buying back our own stock. A lot of times companies buy it back to reissue it to employees or officers under bonus or stock compensation plans. They might feel that the stock is undervalued in the market and they're going to buy it back and hold it. It could be to increase earnings per share. It could be a possibility is to eliminate infrequent reason, I should say, is to eliminate hostile shareholders, a hostile takeover. If a corporation sees that somebody is buying up lots of shares of stock and wants to gain control of one company. So to record treasury stock, we record it simply at cash. And this textbook does not go on. Just the only thing that it discusses at this level is when we buy it. So if they bought 4,000 shares, we simply record it at cost. 4,000 times $8 per share, which is 32,000. We debit treasury stock and credit cash because cash goes down. This is how the treasury stock, remember I said it's a subtraction on our balance sheet, and it's listed after retained earnings. So we take total paid in capital and retained earnings and subtract treasury stock to get total stockholders' equity. Here it says, here's the number of, and this is important, based on our corporate charter, for in this example, there were 400,000 shares authorized. So that's the most that Mead Company could sell per their charter. 1,000 shares are issued, meaning they're out there. They're either with investors or they're treasury stock. And since we bought back 4,000 shares, 96,000 shares are outstanding, meaning held outside of the company with investors. There are different types of dividends, another important part of the stockholders' equity. There are cash dividends, property dividends, stock dividends, and what they call scrip. Dividends can be expressed as a percentage of the par or stated value, or also they could be a dollar amount per share. What we're going to look at and focus on in this text is cash dividends and stock dividends, since they're the most common. So who determines if cash dividends are issued? It's the board of directors that declare dividends and determine, do we have enough cash to give out stock dividends? And we look at they would look at the retained earnings, payment of dividends from retained earnings. You have to have positive retained earnings to pay a cash dividend. You can't have negative retained earnings. And again, it's declared by the board of directors. The important thing for you to understand is the 3 dates associated with cash dividends. There's the declaration date, the date of record, and the payment date. Only 2 of these dates require a journal entry. So if we're looking at this calendar, on December 1st, the board authorizes the dividends. They look at the amount of cash they have, they look at their retained earnings, and they declare that they're going to give out a certain dollar amount in dividends to registered shareholders. Then, on December 22nd, which requires no journal entry, because on the declaration date we're going to set this cash aside, but on the record date we're going to look at who are the registered shareholders, who is going to receive this cash payment. Then the cash payment will be made and another journal entry is required on January 20th. So let's look at the journal entries. So in this example it says on December 1st, media declared the 50 cents per share cash dividend of 100,000 shares of the excuse me, $10 par value common stock. Alright, so the date that we declare it, we're going to debit cash dividends for 50,000. 50 cents for each share. There's 100,000 shares. We're going to debit cash dividends, credit dividends payable. On December 22nd, no entry is required. Okay, we're just looking at the record date, just as who do we have as a shareholder on record. And then on January 20th, we're going to reduce the liability, so we're going to debit dividends payable and credit cash. So on this declaration date, we're just really establishing and setting aside some money that we're going to pay out to our stockholders. Another part to note about dividends is we talked about the difference between common and preferred stockholders, that one of the rights of a preferred stockholders is that when dividends are given out, they receive preference and receive their dividends first. So preferred common stockholders have the right to receive dividends before common stockholders. The per share dividend amount is stated as a percentage of the preferred stock's par value, or a specified amount. So that's important to note. Preferred dividends can be cumulative or non-cumulative. So if you're looking at a homework problem or a problem on the test, you want to underline whether it says cumulative or non-cumulative. If dividends are cumulative, and say every year the shareholders, the preferred shareholders, are to be paid $20,000. So in 2016, I think I just said 20,000. Okay, so in 2016, the board of directors said we don't have enough cash to pay out. So common and preferred stockholders in 2016 received no dividends. The preferred stockholders should be, by what it states, they should receive $20,000 each year. So they didn't get paid, and we're going to assume that these preferred stockholders are cumulative, meaning they get their annual dividend plus any dividends in arrears. So in 2016, they didn't receive anything. They should have received $20,000. Now, in 2017, the board of directors says we have $50,000 we're going to give out in cash in dividends. So the preferred stockholders step up in line, and they get, figuratively speaking, they get their dividends in arrears, meaning their dividends that they didn't get in 2016. They get $20,000, and they get the $20,000 that they're owed for 2017. The amount that's left, because I said they declared a dividend of $50,000, is $10,000, and then that amount goes to the common stockholders. Okay, so that's important to know and understand that there's a dividend preference. First, preferred stockholders get their dividends, but it's also important to understand if there's a cumulative dividend, because if there is, they receive dividends in arrears. If preferred stockholders, in my same example, are non-cumulative, so that just means that if dividends aren't declared in a year, if there's not enough money, they just lose out just like the common stockholders. So say in my last example that preferred stockholders are to receive $20,000 a year. In 2016, the board of directors declares nothing. There are no dividends given out. And they're non-cumulative, we're assuming. The board of directors in 2017 has $50,000 in dividends to give out. So the preferred stockholders would receive their $20,000. We don't go back in time and award them what they didn't get in 2016 because they're non-cumulative. So in the example when they're non-cumulative, preferred stockholders in 2017 would receive $20,000, and common stockholders would receive what's left, which would be $30,000. So here's a problem. Scientific Leasing has 5,000 shares of 7%, $100 par cumulative preferred stock outstanding. So if I were to see this as a problem, I would first say, oh my gosh, there's a lot of information here. What do I need to pull out that I need? It says each $100 share pays a $7 dividend. The annual dividend is $35,000. Okay, so the preferred group receives $35,000. How I would figure this is there's 5,000 shares times the $100 par value, which would give me $500,000 of preferred stock outstanding. Then I would multiply that by 7%, which gives me the annual dividend of $35,000. Okay. They did it a little different. They said each $100 share gets 7%, so they took 7% times 100, which is $7. There's 5,000 shares. $7 dividend times 5,000 shares gives you 35,000. It gives you the same thing, just a different way to arrive at it. So again, what's important here is they're cumulative. And it says if dividends are 2 years in arrears, preferred stockholders are given the right to receive the following dividends in the current year. So they would receive $70,000 for the 2 years they're in arrears and $35,000 for the current year, a total of $105,000. When we talk about stock dividends are a pro rata distribution of the corporation's own stock. And what's important to note here, and I think this is a good visual description, is that before the stock split, here's how we look. And this is our box. We have 10 shares, 10 shares, 10 shares, 10 shares. That's 40 shares. But then the box size is the same. But then after we split, so the number of shares owned increases, but the percentage of the company owned remains the same. So it doesn't increase because you have more. The par value goes down. So let's look at an example. Again, stock dividends are another way to reward our shareholders. We give them cash dividends, but stock dividends is another way to, maybe we don't have enough cash on hand, but we want to give them something, so we're going to give them stock dividends. So what stock dividends do is that they change the composition of the stockholders' equity, but the total stockholders' equity remains the same. There's no effect on par or stated value per share, and it just increases the number of shares outstanding. So here is an example. They declare, Medlin declares a 10% dividend, stock dividend, on $10 par common stock when 50,000 shares were outstanding, and the market price was $15. So let's look at here. We have common stock, $10 par, so we take $10 times 50,000 shares, that's 500,000. And my retained earnings were 300. My total stockholders' equity is 800,000. My outstanding shares is 50,000. Then the stock dividend is a 10%. So they take 10% of the 500,000. So after the dividend, common stock is 550,000. Paid in capital, 25,000. So my total paid in capital increases by 75,000, but retained earnings, because we're taking that stock dividend out of retained earnings and giving it to investors, goes down by 75,000. So what remains the same? Total stockholders' equity does not change with stock dividends. Let me say that again. Total stockholders' equity does not change. It does not change. If you go back here to the previous slide, whoops, gotta go back. It says total stockholders' equity remain the same. Okay. So let's go on. So here is the journal entry for stock dividends. They declare a 10% stock dividend on 50,000 shares, $10 par value. The market value is $15. So the difference between the two is between the market value and the par value is $5. So that's where we get the $5 times the 5,000 shares, which would be the paid-in capital amount in excess of par value. So this is the journal entry to record the declaration date when we declare stock dividends. So stock dividends, stock split, again, have no effect on retained earnings, just a reorganization. So then when we go ahead and we issue the dividend shares, we're going to debit common stock dividends distributable and credit common stock. Stock splits. Again, I think the picture is helpful. Before the stock split, after the stock split. They have no effect on retained earnings. The number of shares owned increases, but the percentage of the company indicated by the same size of the box remains the same. Stock split decreases the par value, increases the number of shares. So if I were to take simpler numbers here and say I had owned 40 shares here, but now it looks like instead of 40 shares, I own 40 times 4, 160 shares, but my par value has gone down. So again, with stock splits, there is no change. So before they had 50,000 $10 par shares. After, they had 100,000 shares at $5. So when you multiply 50, you're just dividing it in half. I divided in half the par value, and so, but then now I have more shares, so the total amount in common stock after the stock split, this was a 2-for-1 basis, remains the same. Again, the stock split has no impact on stockholders' equity. All right. So that's the end of my review for Chapter 11. Make sure that you also understand the terminology that's associated in this chapter. There's a lot of terminology. You want to understand, what par value is, what stated value is. You want to be able to do the dividend journal entries. Understand the impact of a stock split. What are some of the advantages of the corporate form of organization? Understand the impact of be able to do the journal entries for common stock, preferred stock. When preferred stock is cumulative and non-cumulative, if I gave you a scenario, could you explain who received dividends in arrears and who didn't? So understanding that concept of cumulative, non-cumulative. I hope this was helpful. Thanks for watching and happy studying.